Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about, share it on social media. I'm going to interject my financial opinions as we go. It's going to be a wide array of things. It's going to be commodity, wealth building, and financial topics is generally what I cover. When I go over this, and we'll dive right into it. If you want to follow me, it's at finding_finance. And if you want to join our website, join our community, finding-value.com. We talk a lot about all of these topics in terms of financial topics, individual companies, wealth building, ratios, anything basically that you want to learn. And that's where the value is learning these things to become a better investor. So scrolling down, we've got Uselink here, Casper. He's got UX1 divided by West Texas Intermediate Crude. I thought it was a really interesting chart here. So this is a kind of a longer term outlook back to 2008 all the way till 2023, where we are today. This is a ratio. It's the uranium futures price versus West Texas Intermediate Crude. Again, we've got a strong resistance line going across your trend line. Could we be breaking to the upside where uranium really starts to outperform crude oil, like a massive breakout? Or do you think crude oil is going to start to work its way on higher? Um, I think uranium could break out against crude and really start to run. I think that's a possibility. We'll find out. And obviously, I'm going to be watching this, but very interesting chart. I think there's a lot of value in it. And what I did is I went and I looked back at a lot of the uranium ratios. Uranium to silver. I mean, look at this, guys. This looks fantastic. It's breaking out of a basing formation. Looks absolutely fantastic. Uranium versus the S&P 500. Another one that is breaking out of its basing pattern, moving to the upside. I mean, these are all basically starting to get into full stride as we break away from those basing patterns and jumping off that base for a lot of these ratios. Uranium versus gold, another one that's jumping kind of, I consider this the first base here. So this is our kind of first double bottom basing pattern. We had a lot of resistance on top of that we've punched through. And we could easily get moving to the upside here with great speed. So again, momentum down, sideways, and now the momentum starting to work its way on up in the ratio. Uranium versus crude oil, that chart that he was talking about here. Um, let me kind of amplify this move here. And what he did is he just, I think, basically you could come across this way, come down on the breakout, and that's how I would view it. Is on these tops here. These are the closing prices. Some people they prefer to go off of the where it traded briefly. This is I'm on the monthlies here. This to me looks like we have a breakout in uranium versus crude oil already using a monthly candlestick chart. And obviously you can use different time frames and get maybe perhaps different results. But to me, this looks like we've already broken out. And so uranium looks really strong against crude oil. Uranium looks great against copper. It looks great against, wait, natural gas. Natural gas actually looks pretty good. I'll admit it. It looks really good. And I don't know which direction uranium and nat gas, who's going to be the winner here. I don't know. Uranium versus Dow Jones looks fantastic for uranium coming out of that basing pattern, starting to get some momentum on the right side. Uranium versus platinum. Look at that thing go. I know platinum's been weak and uranium's been pretty strong. And that's what that combination looks like. Big move there. Uranium versus the M2 money supply. Also a huge outperformance of uranium. So, I mean, looking at all these, uranium by far looks to be one of the strongest commodities out there. Nat gas could also be another strong performer. This is nat gas versus platinum. I think nat gas looks really good in all of these different ratios. Nat gas versus gold futures pricing. Still has more work cut out for it. We still have to break a lot of resistance levels that uranium has already broken, but we're at very, very low levels. Uranium versus, or natural gas versus uranium, very cheap. Nat gas versus crude oil, incredibly cheap. Look at this, guys. Look where the red line is. This red line's below the entire bull market that occurred from 1990 onward. We are cheaper than all of that. And we are ramping up our usage of nat gas. And look at this is such an opportunity here. Well, at least in my opinion, it is. Nat gas versus copper, looking good. Very, very cheap level, below the entire bull market back here. But this here is just one big natural gas bull market there. It's massive. And I think that we're setting it up another bull market. Nat gas versus Dow Jones. I really like this chart. What this is a breakout, and this is your retest. It looks really good, and it's really cheap in relationship to history. You can see the red line is down here going across. It's cheaper than the entire bull market that started in 99 onward. Nat gas versus palladium, super cheap, and it is coming on up, so that's looking good. And nat gas versus Baltic, they're both really cheap, probably some of the best sectors to be looking at. But just wanted to go through those because they all looked incredibly good. I think we're kind of already breaking out if you use the closing prices and depending on how you set that up, or maybe we're real close to breaking out. But uranium's got a really bright future. It looks good against all the other commodities, and it's a sector that I would definitely be watching at a minimum to learn something from. Nat gas is cheap against everything. It's got more work cut out ahead of it, and we might see weakness in the short term depending on the weather. But again, nat gas is another one that I think looks absolutely fantastic. And I've got a lot of ideas. Don't worry, guys. I got a lot of ideas around uranium. Got a lot of ideas around natural gas companies. And again, we talk about these in our community on finding-value.com. If you're interested in learning about how to play these with individual companies, Canadian companies, American companies, ones overseas, all around the world. We talk about a bunch. We even talk about drilling companies that are going to benefit from all this. And all the liquefied natural gas terminals coming online, all that stuff. Just a reminder for all you guys, Roth IRA and 401k contribution limits for 2023 and 2024. If you haven't contributed to your 2023 and or 2024 that's going to be coming up, those are the limits, 6,500 and 7,000. If you are able to contribute to a Roth IRA, those are the limits. I try to hit these limits. I do a backdoor Roth IRA contribution, and I try to hit the max in these. What a Roth IRA is, and maybe you guys already know it, it's an investment account that you create with a brokerage account. You can put up to $6,500 or $7,000 or greater if you're over 50 years old. And it earns tax-free. So you take after-tax money, you put it in the account, and it earns tax-free. For your 401k 2024 limit, it is increased by $500 for the employee contribution from $22,500 to $23,000, a $500 change. You also have the traditional and or Roth contribution moving up $500. And then you've got your catch-ups if you're over 50. Your health savings account also has gone up dramatically. If you've got a family, this is what I'm looking at: 7,700 to 8,300. It's up $600, and this is up 300 for individual contributors. So I take advantage of every single one of these accounts here. I have employee and employer contributions that I can do. I do my traditional to a backdoor Roth. And then I also max out my health savings account contribution. What I do there, and again, I'm not a tax expert. It's not, don't look at me as for tax advice or anything like that. But what I try to do is I try to use dividends in my health savings account. And when I have qualified expenses, I try to cover that with the dividends in the account. I can invest in individual companies depending on, mine's a Fidelity account, but you can invest in individual companies. You can invest into whatever you want. And some of that I really pumped the dividends, and I used the dividends to cover my healthcare expenses or my family's healthcare expenses. Here's Kobayashi letter. It says the median list price on U.S. homes has declined for 4 consecutive months, according to obviously our boy Reventure. However, even with these declines, prices are still only down 6% from their all-time high. The median house in the U.S. is now selling for a whopping $425,000. All as mortgage rates just crossed above 8% for the first time in 23 years. I think that pulled back recently. Housing affordability is still getting worse. Now, when I see this, I know they're pointing this out, but every time I look at October, it looks to me like every single year it's down in those months. All it does is it cycles back and forth. Every single year it cycles. And obviously they're using these, they're like, oh, it's down, it's declined for 4 months. Yeah, but that's the natural cycle. It did it in October here, it did it in October here, October here. It cycled this like this every single time. So I don't know why this would be any different than any other year. It doesn't make any sense to me. And I know they're trying to push fear into the market, but to me, it doesn't look any different. It just looks like the normal cycle that we're seeing, and it's not anything worse than basically any other year that I can see. So I don't know. It's just normal data to me. And in fact, the way that I view this, your median listing prices is actually it's getting stronger with time outside of the spring rally here. It's got a little bit weaker than these other ones back here. And I know you get a mid-cycle wobble in the middle of the housing market. So what I did, I know there's a lot of people who are really bearish on the housing market, and I want to share some information with you guys. This article, and I'm not cherry picking this, I just picked it because it had the data all in one article. This was written in March 8th, 2023, and according to this article, the housing market is short 6.5 million homes. This here is that inflation from bank lending that could occur. The affordability could obviously slow this all down. I get it. But this is what is out there in terms of the actual deficit. Now, I was looking down here. This is kind of what caused the deficit. In the decade between 2012 and 2022, 15.6 million households were formed. And during that same period, 13.3 million houses were started. So there's a gap there between family formations and how many houses have been built. This includes 9.03 million single-family homes and 4.2 million multifamily homes. Of those, only 8.5 million single-family homes and 3.4 million multifamily homes are completed. So there's this gap of 6.5 million in the market as we speak. And it's between household formations and how many homes have been built in the market. So here's another thing that I wanted to cover here. Multifamily building helps, but household formation is outpacing building. And I don't think people understand that. Everyone says, oh, we're going to go into this big crash. I don't think so. I think it's going to go in the opposite direction. It's going to go higher. As weird as that seems, I think that we are going to go higher in home building and all that stuff at some point. I don't know if it's going to be short term. We may have to go through a slowdown and get interest rates to kind of cool off, and then it goes. Whatever it is, maybe we are in the middle of a mid-cycle wobble, potentially. So if we look at this, the United States saw the highest level of yearly household formations in the last decade, with 2.06 million new households outpacing housing starts. This widened the gap between total housing starts and household formations from 1.8 million housing units between 2012 and 2021 to 2.3 million units at the end of 2022. What does that mean? It means that households are being formed faster than what they're building homes. And the deficit is getting worse, not better. Getting worse, not better. So what happens in order to close the housing gap? Well, according to them, it says, however, if the rate of the total housing starts increased by 50% from the 2022 rate to an average rate of 2.3 million housing starts per year, it would take between 2 and 3 years to close the existing 2.3 million home gap, assuming an average rate of household formations over the past decade of about 1.3 million. This would take building back to levels seen in the early 1970s and some of the peak months for building in the mid 2000s. We need a larger housing market boom than any period in history to catch us up with the shortage and deficit in the markets. And that is assuming that the household formations are average. Last year, it was way above average. It was, in fact, 2.3, which was 1 million more than average. So the intensity of household formations is getting worse, not better, and the deficits are growing at this current time. I wanted to cover that, just make sure you guys got that information. Tavi says, mate, nice words, but your explanation makes zero sense with our initial discussion. Let me break it down what I disagree with you so we can move on from this. Miners go when gold is able to outperform inflation. Has not happened yet. No one would disagree. In fact, the whole industry is aware of that. You can skip trying to understand the fundamentals, completely disagree. And here's my answer again. Identifying a great business at historically distressed prices with gold on the verge of initiating a long-term cycle seems to be much more compelling strategy, in my view. I'm a hybrid. I think I agree with Tavi in terms of picking your companies. I think you need to know the fundamentals of the company. I also think technical analysis works as well on top of looking at the fundamentals. I think looking at technical charts for good setups and then looking underneath the hood at the fundamentals are a good way to understand the company the best. But the fundamentals will change rapidly depending on the price of the commodity that company sells. And what I look for is leverage. I want a company that is volatile. Yeah, I get it, but and that might not be great for some people, the volatility, but the volatility is going to give you the upside leverage. I want a company that really moves and gets us some returns. And there's a lot of companies in nat gas and uranium and other sectors that can really smack the leverage down, and energy service and oil. The growing gap between gold and mining companies is about to gain significance as the precious metals gears up for a major breakout, likely marking the beginning of a new long-term cycle for precious metals. Although mining companies are complex, capital-intensive businesses, there are historical periods when this industry proves to be exceptionally profitable investments. If we're indeed on the verge of a secular move in gold prices, and I completely agree with that, miners are arguably one of the most undervalued companies in financial markets today. In an environment where inflation remains higher than historical standards and hard assets excel, these stocks have potential to yield significant returns, possibly becoming multi-baggers or hundreds of percent returns. This is GDX versus GLD. You can see that we are coming on up slowly. And there's this big gap that is formed between GLD and GDX. And that gap, I think a lot of people are speculating, is going to close and then outperform at some point for the mining companies. The question is when. I get it. Coming on down, median home prices are contracting aggressively. In just 2 years, the percent change has gone from over 20% to minus 8%. This is the sharpest collapse on record. Current levels have occurred only 2 times in the last 60 years. The thing I'll say here is the affordability is so bad that more homes are moving that are cheaper than the middle sector homes. Volume has dropped rapidly too. So the median home price is the middle home price. It doesn't mean that the middle home price has contracted and is losing money. This is only that the median home price that is being sold today has gone down. So if you're selling a lot more volume of cheaper homes, your median price contracts. It doesn't mean that the median home, that price has contracted by 8%. That's not what this is meaning. A lot of people are taking this and then they're comparing it to eras where we had housing market busts. The housing market busts during those periods had median home prices collapse, agreed, but it was for completely different reasons. Those were in hypersupply phases. This is not in a hypersupply phase. And those prices also went down as the home price went down. So what caused the problem there were the home prices were crashing. What we have today is not home prices crashing. We're selling more cheaper homes. And the volume of cheaper homes is making the median price decline. Bannerman seeing some nice action tonight on the ASX. So some of these ASX companies performing quite well in uranium. Bannerman, here's another one for Uselink. On my beloved Renko bars. And if you notice, guys, these things haven't broken out on a Renko chart yet. And I know some people think that we're like in the optimism phase. I think we're way before optimism. We're in disbelief. We are so early. If you look at ratio charts and all that stuff, I mean, we're barely coming out of bases for the uranium futures pricing, and then the equities are all lagged behind the futures pricing. So we haven't really broken out of a lot of these downtrends on certain charts yet, like the Renko chart here on Bannerman. Lynn, I completely agree with this. It took 2 decades for the stock market to durably surpass its early 1970s highs after adjusting for CPI. And it took about a decade and a half for the stock market to surpass its 2000 high after adjusted for CPI. Accumulated dividends help to shorten the time a bit. So this is the Wilshire 500 price index divided by the consumer price index for all urban consumers. And you can see these big basing patterns. These big basing patterns are inflationary periods. So we have an inflationary period here. We have another inflationary period here. Then we have another inflationary period. Oops. We have another inflation period here. And I agree with her. And she's got a red line starting here, thinking that it could take maybe potentially a decade or 2 decades for the stock market to durably surpass its high here. So it took a couple of decades here, took about a decade here. And I think we're going to take about a decade to maybe even break above this red line that she's put in there. Yeah. There's one thing in common with all these predicting a real estate crash. None of them own a home. I know, they all are predicting these crashes and none of them own a home. That is kind of weird. For whatever reason, gold bugs seem to believe the only valid investment is gold. There are times, however, when metals are just trapped and not doing anything. I warned over and over that the cartel would fight tooth and nail to prevent gold from recovering $2,000. This is exactly what is happening. Instead of getting frustrated, traders just need to look for other trades while this process plays out. I called the bottom of the stock market ICL on November 1st and tried to get people to lighten up on metals and allocate more capital to stocks. Unlike gold, that will be suppressed, stocks will be protected. Those that listened and took my advice are now making good profits in their stock trades while we wait for the suppression of metals to break, and it will break. Commodities are starting the second wave of the inflationary cycle. Metals aren't going to be left behind, but the banking cartel and government are absolutely going to make it difficult for a bit. So he thinks that this is the 3-year cycle low has bottomed here October of 2022, maybe so early 2023. So, and then in June, the second wave of the inflationary cycle is beginning. It should be you have a first wave, second wave, and third wave. There's 3 waves. So that's what he thinks for Gary Savage. 60% of homes have a mortgage of 4% or less. 38% of homes in the U.S. are paid off. If you think there's going to be a housing market collapse in 2024, you're wrong. That's what they say. Real estate couple there. Don't let yourself get fooled. This is U.S. stocks priced in gold. You can see that the Russell 2000 is below. This line is lost right here that he's got the trend line. And we'll see if we can bounce up and roll back over. Something to watch. In these inflationary cycles, generally, you start to see stocks, especially these small caps, start to underperform. And that's what we're watching. It's another sign of what the market conditions are. And if these start to roll over, the market conditions are ripe for commodities, precious metals, etc., to all move higher. So 5 years of a huge melt up in the spot of uranium. Unless mining regulations change, there will be no new mines of a size that can fill the gap for at least 5 years. Mining regulations are not going to change anytime soon. What's going to happen in those 5 years? Hopefully, fireworks for uranium investors. I already covered this one before. You can skip it. What is your plan for your uranium profits? I will put a third into physical gold to know it's safe. A third will be reinvested into fund retirement. The other third will be a fund. I don't know. I don't really think about it because I don't know how much it's going to go up yet. I just know it's a really good setup. It's really cheap, and whatever is cheap at that time, I probably do know a little bit. I might roll it into potentially another house or something like that. That's probably what I would do with it. Part of it. The other would go into some physical metals, perhaps, and then the other could be for fun. So I would say physical metals, a fund, and maybe house or something, or land, or I don't know, something. Crazy stat: 34% of U.S. home purchases in September were made in cash. Seems like there's still a lot of dry powder in the economy. Another thing to think about is if people are less willing to invest into bonds, where are they going to put the money? Where are they going to roll it into? Here's gold, and this does look like a pretty cool chart. Look, you can see the cup and handle here. Um, we haven't broken out yet. That's what we're waiting for. Everyone's waiting for that. Here's another cup and handle. While many investors cry every day that technology is too important to the U.S. stock market, technology just closed at new all-time highs, continuing to help drive the U.S. stock market higher. You can complain about it or embrace it. It's up to you. And tech stocks have just started breaking out of this cup and handle. Some people say that the S&P 500 and maybe even the Nasdaq will lead the commodity bull market higher, like it did last bull market. Maybe that's the case. Maybe this is a signal that it's leading it. I know a lot of people are very bearish. They think that we are going to get this big crash. What I'll say is maybe the crash is behind us. Maybe the slowdown is behind us. Maybe this consolidation is the slowdown and we are coming out of it. I don't know. But, I'm seeing strength across a lot of different sectors, not just technology. And again, I don't know the future. Maybe there is a slowdown that still exists. Maybe not. But the charts generally rule my thoughts. And if we're starting to see strength in home builders, if we're starting to see strength in technology, maybe something's coming and people are positioning in it, and maybe we get lower interest rates. I don't know what the deal is. I don't know what would be the driver necessarily. I know everybody wants a narrative to tell them what will necessarily happen. I just think this is an interesting chart and we could go higher. It looks good. This is the relative value of real assets to financial assets is highly correlated with inflation. 70% since 1970, making them an excellent hedge against rising inflation and interest rates in coming years. So this is secular trends of 2020s to spark bull market in real assets. You can see the bottom here. Look how low we are against financial assets. We are below everything in history, everything. So real assets are cheaper than any time in history, going all the way back to the 1920s. And we went all the way to levels over 1. So if we're at 0.2, that means that hard assets could outperform financial assets by a factor of about 5. Quite a bit outperformance there. A lot of interest. Gold completed its 8-year cycle low at the same time that euro potentially ended its bear market. If the euro has bottomed and the dollar topped, it's going to be much harder for the banking cartel to keep gold suppressed. And that's suppressed in US dollars. A lot of the times when you see these bottoms in other currencies, the dollar starts to weaken. We have looser monetary policy than other currencies, and those other currencies start to get stronger. We could potentially see emerging markets do very well. We're going to see breakouts in other emerging markets, and that's exactly what we're seeing. As other currencies start to strengthen against the US dollar, and then what generally occurs is that the commodity prices go up when measured in US dollars, just like precious metals and everything else. 64% of Americans would welcome a recession if it meant lower mortgage rates per USA Today. That seems kind of interesting. I think there's a ton of buyers if rates were to come back down. It's like a whole herd or gaggle of people that would buy if rates were lower. I know a lot of people that have told me that don't own homes. They said, hey, if these rates drop, I'm going to buy a house immediately. Problem is, there are a lot of people that are like that. I don't deny that the rates, as high as they are impacting affordability and probably drastically have an impact on the volume of home sales. I agree with that, but I don't think that rates going down. I think if rates go down, sales volumes are going to explode. That's my take on it. It says it's difficult to get rich, but it's very easy to not be poor. If you want to escape poverty, here's all you need to do: budget, get out of debt, save, invest. Yeah, pretty simple. Oil supply equals demand. The main problem at hand is that the world oil supply is in trouble because it hit the Red Queen syndrome. We need to replace a Saudi Arabia worth of oil declines each year. Thus, the world hits the energy cliff circa 2025. And here we are moving on up, and this is what we have to replace each year with estimated annual oil declines, 10.5 million barrels. That's a Saudi Arabia every single year just to stay flat. Moody's changes outlook on U.S. rating to negative, citing massive fiscal deficit and political polarization, which exacerbates fiscal risks, but affirms AAA rating. That's interesting. We do have a big divergence here in the gold price. The law of one price says something cannot trade at two different prices in two different currencies, X trade frictions. Gold and oil are now priced in both USD and CNY, so the gold to oil ratio cannot be different in USD versus CNY. Implications of this have quietly begun manifesting itself. So we've got a differing price in China versus the United States and a different oil to gold ratio. He's saying that this basically cannot happen, and it's happening. So we'll see how this kind of works its way out, this gigantic divergence here. Perhaps these guys that think that gold is being manipulated lower are right, and that's why this gap exists. This is marginal tax brackets for 2024 tax year, just to see you guys what tax bracket that you're in. And it's not really a bracket. Everyone pays, 10% on the first 23,000, 12% on this in here, and et cetera, depending where you're at. And the last one here is Fed's daily. If financial conditions ease more, the Fed would need to take note. The Fed is literally trading equities and bonds in a 5-10% band and buying time, hoping inflation goes away. So that's what I've got for today, guys. Give me a thumb up for the content, subscribe to the channel, subscribe to the website, and hopefully you guys are having a good day. We'll catch you later. This is Finding Value.